imposed a 145% tariff on Chinese imports, combining a new 125% levy with an existing 20%. This isn't just policy, it's a full-blown economic assault. What's more shocking? The White House only confirmed the final figure after confusion spread inside Congress and the administration itself, exposing how fractured, chaotic, and uncoordinated Washington's trade strategy has become. But the damage is already ripping through the global economy. According to China's Ministry of Commerce, the hardest-hit victims are small and medium-sized enterprises, SMEs, the backbone of China's export economy, making up 60% of total exports and 80% of private sector jobs. In the first quarter of 2025 alone, China's small exporters saw a 30% drop in orders, crushed under the weight of skyrocketing costs from America's tariff blitz. Worse still, foreign companies are now accelerating plans to relocate production out of China, creating a dangerous exodus that threatens to permanently reshape the global supply chain. This isn't just a blow to China, it's an economic earthquake, and its aftershocks will be felt from Shenzhen to Silicon Valley. China's exporters aren't just battling tariffs. They're fighting to retain foreign investment as global confidence in Beijing's economic stability crumbles. Trump's declaration, "I will impose global tariffs," wasn't an empty threat. It was a geopolitical shockwave. The message was clear: comply or face economic warfare. Beijing panicked. Brussels froze. And while Washington played global enforcer, the European Union, initially defiant, buckled under pressure. European Commission President Ursula von der Leyen once called for a unified resistance to Trump's aggressive trade agenda. But her words faded fast. Like a boat caught in a hurricane, the EU soon began backpedaling, abandoning coordinated pushback and turning inward to protect fragmented interests. This isn't just about tariffs. It's a global power realignment, orchestrated through economic coercion. And ironically, the very allies the U.S. claims to defend are being forced to yield, undermining the credibility of Western unity in the face of economic extremism. At first, Europe threatened fire and fury. Top EU officials warned that Trump's tariffs would trigger a global economic collapse, and Brussels declared it was finalizing retaliatory measures, including tariffs on American steel and broader countermeasures if talks failed. But then came the complete reversal. Just days later, European Commission President Ursula von der Leyen did a political U-turn. Her new message, not retaliation, but negotiation. "We are ready to negotiate with the United States," she declared. "Indeed, we have offered 0 tariffs for industrial goods. This isn't diplomacy, it's economic surrender under pressure." Washington didn't back down. It tightened the noose, and Brussels folded. This exposed a harsh truth. The EU's rhetoric of resistance was hollow. In the end, the economic pressure from the United States forced Europe to abandon confrontation in favor of concession. What began as talk of collapse ended as capitulation. While Europe quietly surrendered, China went into full combat mode. At first, Trump demanded that Beijing remove its 34% retaliatory tariffs. The response? A flat number. Instead of backing down, China doubled down, imposed an additional 34% tariff on U.S. goods, restricted exports of rare earth materials, vital to U.S. tech and defense industries, and targeted 30 new U.S. entities, primarily defense-related firms, on top of the 24 companies already hit by Trump's tariffs. This is no longer a trade dispute, it's a high-stakes economic war. And Trump? As expected, he escalated further. "If China doesn't remove the tariffs," he warned, "I'll hit back with 50% more. Or maybe even 104%, who knows?" This rhetoric isn't random, it's deliberate brinksmanship. Unlike the EU, which flipped under pressure, China is digging in, fueling a standoff that could cripple global supply chains, especially in high-tech sectors that depend on Chinese rare earths. This trade war isn't just between the U.S. and China anymore. Canada just stepped into the ring, quietly holding a geopolitical ace, crude oil. As the tariff war escalated, Canadian Prime Minister Danielle Smith issued a chilling warning. "We can sign deals with European and Indian refineries. If necessary, we'll redirect our oil exports, and that solves our trade deficit." That's no empty threat. Canada currently supplies 4 million barrels of oil per day to the U.S., with 700,000 barrels specifically heading to Gulf Coast refineries. If Ottawa turns off that tap, the impact on U.S. energy infrastructure would be immediate and severe. Refineries would struggle to adapt to different crude types. U.S. reserves would tighten overnight. And the price shock? Global. This isn't just oil. This is leverage. While Washington focuses on China, Canada could blindside the U.S. and Trump. He better start paying attention, because one wrong move could trigger an energy crisis. Gas prices in New England are surging. Experts warn of a hike between 20 to 40 cents per gallon. But that's just the beginning of the storm. Luxury automakers like BMW, Audi, and Mercedes aren't celebrating discounts. They're slamming Washington's tariff madness. And the real losers? American workers. Across the board, U.S. industries now face a brutal choice: shut down operations or slash production. Both mean massive layoffs. The tech sector isn't spared either. Silicon Valley giants have lost millions after being locked out of China, one of their largest markets. This isn't just a policy misstep, it's economic sabotage. Even U.S. farmers, once core Trump supporters, are crying foul. Their exports have collapsed under retaliatory tariffs, and support from Washington is nothing but lip service. 62% of industrial workers are feeling crushed, analysts report. The trade war is no longer just headlines. It's job cuts, lost income, and rising fuel bills. Trump's tariffs aren't building a stronger America. They're dismantling it, one industry at a time. I hope it ends soon. That's the quiet desperation of a U.S. farmer on national TV, a man watching his livelihood collapse. This isn't just about tariffs. It's about livelihoods, trust, and global alliances crumbling. Farmers are pleading for Washington to sit down and act like a partner, not a bully. But while Washington drags its feet, Beijing slams the door shut, not just on dialogue, but on two pillars of global tech: ASML and TSMC. In 2023, China spent $2.6 billion on lithography machines from Dutch company ASML. Now, gone. All of it. And it's not just ASML. TSMC, Taiwan's chip titan, is on the chopping block. Beijing's message is clear: we'll do it ourselves, and we'll do it better. This isn't a temporary pause. It's a permanent rupture in global semiconductor cooperation. And it was triggered by one move: Washington's escalation of the chip export ban. America thought it could control tech. Instead, it sparked a cold tech war that could reshape supply chains for decades. In a stunning geopolitical play, the U.S. didn't just ban chip tech, it weaponized dependency. By pressuring the Dutch government, Washington forced the cancellation of export licenses for DUV lithography machines, a cornerstone for making advanced semiconductors. The result? $15 billion worth of ASML machinery inside China was bricked overnight. No maintenance, no updates, no future. It was a calculated strike, and China hit back with surgical precision. But this wasn't a sudden tantrum. Beijing had already been building its semiconductor war chest since 2022. Through state-backed big fund initiatives, China quietly invested over $75 billion into domestic chip design, wafer fabrication, and, crucially, lithography tech. They didn't just throw money at the problem. They recruited over 50,000 engineers, many from Huawei, SMIC, and even Silicon Valley. The result? In just 3 years, China constructed a semi-autonomous chip ecosystem. Factories now run on 60 to 70% China-made tools. Chinese labs are producing in-house chip design software, bypassing U.S. chokeholds. This isn't catch-up. This is China rewriting the rulebook. Forget EUV. China is rewriting the rules without it. While the world fixates on $200 million EUV machines from ASML, China is quietly taking a different route. SAR, a Shenzhen-based firm, claims to have developed its own DUV-based lithography capable of producing sub-7 nanometer chips, a feat once thought impossible without EUV. Need proof? The Huawei Mate 60 Pro stunned the global tech community when it debuted with a 7-nanometer chip, built entirely on banned DUV technology. Now China is pushing further. SMIC has reportedly entered testing for 5-nanometer production and is aiming for 3 nanometers using a combination of AI-powered yield optimization and quad patterning techniques. This isn't just progress. It's a paradigm shift, and the consequences are already global. ASML's revenue plunged 27% in Q4 2024 after China stopped buying its machines, a direct blow to the Netherlands' tech jewel and Europe's semiconductor leverage. But this is no longer just about chips. As tensions escalate, China has begun offloading U.S. treasuries and pulling out of major tech stocks, Apple, Nvidia, and others. This chip war, it's rapidly transforming into a currency war, with global financial stability in the crosshairs. If Beijing plays its next card, it won't just be a blow to Washington, it'll be a direct hit to your bank account. Mortgage rates could soar, tech stocks might plummet, and your 401k vaporized in a blink. This is no longer just a chip war, it's a financial war. Beijing is now wielding its tech influence as a monetary weapon, capable of shaking Wall Street with just a few strategic sell-offs. And it's already begun. China's semiconductor footprint has quadrupled since 2020. SMIC now controls nearly 20% of the global foundry market, a staggering leap that signals a tectonic shift in tech leadership, from Silicon Valley to Dragon Valley. This Dragon Valley isn't a metaphor, it's Shenzhen. It's where chips are designed, manufactured, and now weaponized. If you're holding a smartphone, driving a modern vehicle, or running a tech-enabled business, your future already runs on Chinese semiconductors. And the U.S.? It's no longer just fighting to control trade, it's fighting to retain relevance. Donald Trump thinks the U.S. is doing Japan a favor. We protect them. They don't protect us. That's how he justifies the 25% tariff bomb dropped on Japanese cars. But Tokyo isn't laughing. Japan's government issued a chilling response. If the U.S. harms us, we will retaliate accordingly. This isn't just a trade skirmish, it's a diplomatic rupture. For decades, Japan maintained a U.S.-centric foreign policy. That era may be ending. Japanese state media are no longer using polite language. They're now calling for independence, economically and strategically. Japan is pivoting, realigning trade ties, building new alliances with the EU, Canada, and Southeast Asia. If Trump continues down this path, he risks severing America's oldest Pacific partnership, one that has underpinned global economic stability for half a century. This is more than just tariffs on Toyotas. It's about trust, and that trust is evaporating. If Donald Trump thought tariffs would punish Japan, he may have miscalculated badly. Over 1 million American jobs depend on Japanese companies, mostly in manufacturing across the Midwest. Now, those jobs are hanging by a thread. For 4 consecutive years, Japan has been the #1 direct investor in the United States, pouring capital into factories, tech plants, and automotive hubs. If this economic link is severed, the fallout will be catastrophic, not just for workers, but for America's strategic dominance. This isn't just about lost trade, it's about military realignment. Tokyo is rapidly boosting its defense budget and pivoting hard. Instead of relying on U.S. giants like Lockheed Martin and Raytheon, Japan is now opening defense contracts to Europe, courting France, Germany, and Sweden. That means the U.S. could soon lose not only billions in weapons exports, but also its closest military foothold in the Pacific. This is a geopolitical earthquake, and Trump lit the fuse. The United States is staring down a crisis that goes far beyond tariffs or trade. If Japan cuts back on defense cooperation, the consequences will be seismic. Thousands of jobs in America's defense industry could vanish overnight. But that's only the beginning. What's truly at risk? U.S. military dominance in the Pacific. Japan has been Washington's largest defense shield in Asia, the critical counterweight to China. Lose Japan, and the U.S. loses its strategic stronghold in the region. But the danger doesn't stop there. A realignment in Tokyo could trigger a domino effect. If America's most loyal ally starts pivoting, why wouldn't others follow? The ripple could upend decades of U.S.-led military architecture, opening the door to a new multipolar world where America no longer calls the shots. This is no longer just about Japan. It's about America's fading influence, militarily, diplomatically, and economically. Trump's 25% auto tariff was pitched as a patriotic move to protect American jobs, but in reality, it's a blowtorch to the American economy. Car prices are skyrocketing. A $48,000 vehicle, now $60,000. Consumers are squeezed, workers are losing jobs, and China? It's watching with a smirk. Even the Ford F-150, the so-called American car, is no longer truly American. Despite being assembled in the U.S., it relies on over 30,000 parts from 24 countries. Alternators from Mexico, wheels from South Korea, drive shafts from Canada, each now slapped with a 25% tariff. The result? American manufacturing gets choked by its own supply chain, and families pay the price. This isn't policy. It's economic self-harm, served with a flag. Trump promised to bring car manufacturing back to America. Instead, he brought back higher prices and economic pain. Here's the brutal math. Import tariffs on Canadian and Mexican parts, plus $3,000 wheels and electronics from South Korea, plus $3,000 to $6,000 steel and aluminum tariffs, plus $400 to $600. That's up to $12,000 extra per vehicle on a car that once cost $48,000. Consumers pay more, companies cut margins, and automakers? They're not rehiring, they're automating. Trump claims business is coming back. But the truth is, robots are. To avoid paying tariffs and stay profitable, many automakers are investing in AI and robotics, not American labor. This is not a return to industrial glory. It's the death of middle-class manufacturing. Bringing the entire auto supply chain back to the U.S., it's not patriotism. It's a logistical nightmare. One study reveals that relocating the full automotive supply chain domestically would take years and cost billions. Worse, it risks lower quality parts and production delays, the exact opposite of what a competitive industry needs. The U.S. auto industry was once a global benchmark for supply chain efficiency. Now, thanks to Trump's tariff war, it's spiraling into disarray. The foundation of American auto production, built on decades of trade partnerships with Mexico and Canada, is crumbling. Instead of focusing on EV technology, AI, or global expansion, automakers are wasting time arguing over parts sourcing. They're stuck debating. Can we still afford to import from Mexico? Is there a U.S. supplier for this part? Will tariffs spike again next quarter? While Detroit debates, Shenzhen builds. And China? It's not just catching up, it's leaving America behind. While the U.S. is still tangled in tariff disputes and collapsing supply chains, China is pulling ahead fast. It has now surpassed Germany and Japan to become the world's largest car exporter, shocking the global auto industry. An automotive strategist bluntly stated, "It's not the strong swallowing the weak, it's the fast beating the slow. And right now, America is slow." This is no longer a competition over horsepower. It's about supply chain dominance, global pricing power, and political clarity, areas where Beijing is winning and Washington is fumbling. China's rise isn't a fluke. It invested heavily in EV technology, state-sponsored battery production, and global logistics. Meanwhile, the U.S. is bogged down by political noise, infighting over tariffs, and outdated production models. If America doesn't pivot fast, it won't just lose market share, it will lose its industrial identity. In a viral moment that swept across the internet, Jamie Foxx's impersonation of Donald Trump wasn't just comedic. It was a mirror held up to a presidency defined by chaos, ego, and contradiction. With uncanny accuracy, Fox captured not just the voice, but the mannerisms, contradictions, and rhetoric that have come to define Trump's public image, from exaggerated bravado to disjointed catchphrases like, "They tried to give me the virus, I beat the virus." What made it resonate so deeply was the uncomfortable truth. The impression didn't feel like a parody. It felt like a replay. The crowd erupted. Social media went into meltdown. Twitter feeds lit up, TikTok couldn't circulate the clip fast enough, and Facebook threads filled with millions of comments, not just laughing but pointing out the blurring line between reality and political theater. In a political climate where policy is often drowned out by performance, the fact that a comedian's satire felt more presidential than the president himself speaks volumes. This moment reveals more than a meme. It's a cultural referendum on leadership and a warning that the U.S. presidency has become a stage, not a strategy room. As Jamie Foxx's Trump impression dominated the internet, side-by-side comparison videos flooded YouTube. Meme culture exploded. Fox descending a golden escalator, hosting rallies with Big Macs, and even facing off in imaginary debates against the real Trump. What began as comedy quickly became political commentary in viral form, a powerful tool shaping public opinion in real time. But Trump, characteristically thin-skinned, couldn't resist the bait. Instead of ignoring the firestorm, he poured gasoline on it, attacking Fox in interviews and online posts, veering from denial to deflection in the span of a few sentences. "It was the worst impression of me. Actually, the best impression I've ever done. Stevie Wonder said it was amazing." This reaction exposed more than just bruised ego. It highlighted a recurring problem. Trump treats every critique as a personal attack, even when it's satire. And by lashing out publicly, he amplified the very mockery he hoped to suppress. In today's media ecosystem, mockery isn't marginal, it's influential. A single impersonation can shift sentiment faster than a press conference. The incident underscores a broader shift in American politics. Public figures are no longer just politicians. They're digital personas, constantly at the mercy of meme culture and online satire. Apple has begun airlifting 600 tons, or 1.5 million iPhones, from India to the U.S. in a stunning move to bypass Trump's crushing tariffs on China. This is not a logistics stunt. It's a signal of panic in global tech supply chains. Apple's decision to charter entire cargo flights marks an unprecedented shift in its distribution model. According to Bloomberg, the operation reflects Apple's urgent strategy to protect margins and avoid 25% tariffs on China-made electronics, which would devastate U.S. retail prices. This escalation is a direct result of Trump's trade war. With Beijing no longer a safe manufacturing hub, Apple has ramped up iPhone assembly in India, a country now poised to become its second-largest production base. What we're seeing is corporate triage. Apple is racing to insulate itself from U.S.-China chaos. The iPhones in your pocket now carry the weight of geopolitics. Apple's strategy to bypass Trump's escalating tariffs is becoming crystal clear. According to a Reuters report from April 10, 2025, Apple wants to bring iPhone models to the U.S. without facing the financial burden of new import taxes, leading to its decision to elevate India as its primary production hub. This operation, which includes airlifting iPhones and other products to the U.S., highlights the scale of Apple's global logistics network. The tech giant, with its complex supply chain spanning multiple countries, is now betting on India's lower labor costs and more favorable trade relations with the US to maintain its competitive edge. Apple's decision to expand its manufacturing footprint in India is driven by economic forces as much as geopolitical considerations. While its China-based operations will continue, India's relaxed trade policies make it an attractive alternative to the increasingly hostile US-China relationship. However, this strategic pivot is not without risks. Apple is now balancing the demands of two distinct regulatory environments. One in China, where production costs are high but market access is unrivaled, and one in India, where labor costs are lower, but infrastructure challenges remain. Apple's massive production pivot and emergency airlifts aren't just about logistics. They're a direct response to Trump's aggressive tariff escalation. The latest increase, from 54% to a staggering 125% on Chinese electronics, has made it nearly impossible for U.S. tech firms to stay competitive if they rely on Chinese factories. Indian media has seized on Apple's move, questioning whether the country is now capitalizing on a once-in-a-generation supply chain realignment. This raises a broader question. Is India becoming the big winner in a trade war that's devastating everyone else? Meanwhile, American consumers are left to wonder, will iPhones now become even more expensive? With tariffs so high, Apple's cost buffer is shrinking fast. The core issue remains Trump's tariff war, aimed at punishing China, is hitting U.S. corporations and consumers in equal measure. And Apple's radical shift to India is not innovation, it's survival. Rosenblatt Securities warns the iPhone 16 Pro Max could soar from $1,599 to over $2,300 if Trump's 54% tariff hits full force. That's not inflation. That's economic shock therapy. Media outlets now confirm that these massive tariffs on Chinese components will be passed directly to U.S. buyers. No corporate buffer, no subsidies, just raw cost. Apple's relocation to India is an attempt to offset the financial blow, but analysts say the shift won't be enough to fully insulate prices, especially for premium models still dependent on Chinese parts. Logistics and production remain fragmented. The bottom line? Apple is firefighting, but American consumers will still pay the price for a tariff war they didn't start. Apple's shift to India is a tactical retreat from China's tariff-laden battlefield, but it's not a clean break. Analysts say only a portion of the Chinese tax burden can be avoided, and only if India scales up to massive production volumes. Despite new factories and growing output, India still lacks China's unparalleled manufacturing ecosystem. That means higher costs, more logistical headaches, and a long runway before India can truly rival Shenzhen. Even in a best-case scenario, Apple may only partially reduce its China exposure in the medium term. Experts view this as a hedging move, not a full exit. This is Apple's message to Beijing: we're diversifying, and to Washington, we're adapting. But make no mistake, the world still runs on Chinese manufacturing. As U.S.-China tensions escalate, India is quietly reaping the rewards. The country has opened its doors to companies desperate to sidestep Trump's brutal tariff regime, offering cheap labor, stable trade ties, and just enough infrastructure to lure manufacturers looking for alternatives. According to BBC interviews, Indian officials now see the trade war not as a threat, but as a rare geopolitical jackpot. By reducing reliance on China, global firms hope to de-risk their operations, and New Delhi is more than ready to help. Still, the shift is partial, and India's gains come with caveats: fragmented infrastructure, bureaucratic hurdles, and limited supply chain depth. Yet for now, it's the best bet in a bad storm. Despite India's infrastructure gaps and regulatory red tape, Apple's aggressive pivot is sending a powerful signal. If the world's most valuable tech company is betting big on India, others will follow. This isn't just supply chain diversification, it's a geopolitical realignment. Inside India, the sentiment is shifting. Once sidelined in global manufacturing, New Delhi now sees the trade war as a launch pad. Could this be our moment? The Indian public asks. But in Washington, the conversation is darker. Some experts say, if the goal is to weaken China, then empowering India might be strategic. But the real question is, does Trump even have a coherent trade strategy? Or is this just chaotic escalation without a roadmap? As U.S. markets stumble again, Trump calls the tariffs merely transitional problems. He insists the pain will be worth it, but Wall Street isn't buying it. Investors aren't just feeling the squeeze, they're watching systemic cracks widen across the economy. Yes, the president proclaims, "We're going to win this war." But what does winning look like? American companies now face fractured supply chains, ballooning input costs, and consumers staring down higher prices. The so-called transition is dragging, with no clear endpoint in sight. Wall Street is no longer just nervous, it's preparing for impact. As tariffs drive up costs and provoke retaliation, American companies are bleeding value on the stock market. Trump still calls it temporary pain, but the hemorrhaging suggests something far worse. Exports are drying up, supply chains are unraveling, and now corporate America is quietly looking for exits. Apple's pivot to India is more than a logistical workaround. It's a warning sign. The U.S.-China trade standoff isn't a phase. It's a new normal. And the world's biggest companies are adapting accordingly. Apple's retreat from China isn't just about avoiding tariffs. It's a response to a deeper geopolitical gamble. Trump's trade war is framed as a patriotic crusade, but corporate America sees a cost it can't ignore. Trump claims China has stolen U.S. intellectual property and distorted the trade balance. These accusations aren't new, but his aggressive use of tariffs is unprecedented in scale. What's Apple doing? They're reading the tea leaves. Their logistics overhaul is a signal. U.S. firms expect long-term volatility, not short-term pain. Apple may be rerouting production to India, but don't mistake this for a knockout punch to China. The iPhone may be iconic, but China's industrial dominance runs far deeper, spanning automotive, rare earths, AI, and more. Still, the optics matter. Each iPhone flown from India sends a global message. China is no longer the only player. That symbolism rattles markets and allies alike. Yet analysts warn, this is just one battle in a sprawling economic war. China's economic integration with the global system won't unravel overnight. The bigger question now isn't just about Apple, it's about the future of tariffs. Are they strategic weapons or blunt instruments of economic pain? Trump's use of tariffs is no longer just economic policy. It's a power move on the global chessboard. Yes, he vowed to protect American jobs, and he delivered tariffs on steel, aluminum, and tech components. But this isn't just protectionism. It's a calculated strike in a broader geopolitical war. China retaliated fast, slapping tariffs on American exports from agriculture to energy. The result? U.S. giants like Apple are caught in the crossfire, forced to rethink supply chains overnight. But here's the truth. Wall Street fears. This is a war with no clear end. Investors aren't betting on a quick truce. They're bracing for a prolonged standoff. Facing soaring tariffs at the U.S. border, corporations like Apple are shifting production out of China. On paper, it looks like a fix. In reality, it's economic whack-a-mole. India is stepping up, offering cheap labor and an open door. Produce here, they say, and skip the tariff pain. But the deeper threat now comes from Beijing. China isn't just watching, it's retaliating in silence. According to Bloomberg, Beijing has started dumping U.S. Treasury bonds, threatening the very foundation of America's financial stability. This isn't just a trade war anymore. It's a financial Cold War, with your 401k caught in the crossfire. If China dumps U.S. treasuries, it won't be a warning shot. It'll be a financial missile. This isn't theory. Analysts warn that if Beijing sells en masse, U.S. interest rates could spike, the dollar could plummet, and Wall Street could nosedive. Compared to this, Apple's shift to India is just a pawn. Bond liquidation? That's a Queen's move. Trump's promise that this is just transitional pain begins to crumble when the world's second-largest economy starts attacking U.S. debt. This isn't just a trade war anymore, it's a war on America's financial core. Apple isn't just moving phones, it's moving geopolitical weight. 600 tons of iPhones, spare parts, and packaging are now airborne. It's a desperate logistics maneuver amid a trade war that's gone nuclear. While each smartphone weighs little, the scale of this air freight is staggering and expensive. Bloomberg reports that airlifting electronics instead of using sea freight increases shipping costs by up to 20 times. This isn't just about urgency, it's about survival. Apple is racing against tariffs that could cripple its U.S. margins. Commentators say this scale of airlift reflects a cold, strategic calculation: pay now or bleed later. Apple's secret weapon? Made in India iPhones quietly glide through U.S. customs, dodging brutal tariffs that hammer Chinese models. Leaked data reveals what Apple won't say publicly. Importing from India slashes tariff costs significantly, while Chinese iPhones now face up to 25% in additional duties. That cost delta? It could mean hundreds of dollars difference per unit on premium models. American consumers will feel this directly. A shift in Apple's production strategy isn't just geopolitical, it's hitting wallets on Main Street. Indian production won't eliminate the pain, but it could soften the blow. iPhones are no longer cheap, and that's no accident. The Trump administration is pushing a clear message: big tech must pay, and in the long run, American workers will win. But Wall Street's not buying it. Analysts warn this strategy may backfire. Costs are rising, demand is softening, and consumers are stuck footing the bill. Meanwhile, India is seizing the spotlight. Apple's production shift is generating cautious optimism. If tariffs continue reshaping global trade, India could rise as the next manufacturing superpower. In Delhi, headlines tout Apple's move as a historic pivot, but experts warn, without major infrastructure upgrades, India can't match China's scale or speed. The big question now: can India deliver before the next wave of tariffs hits? Apple's relocation is more than a logistics decision. It's a geopolitical jolt. For India, this could catalyze long-overdue reforms in infrastructure, capitalism, and global trade logistics. Indian officials see Apple as a signal flare: break free from China, come here. If enough firms follow, India could unlock the next phase of double-digit growth, but China won't watch silently. Analysts warn Beijing may retaliate with incentives or retaliatory pressure on companies that abandon its market. The message from Beijing is clear: you don't leave China without consequences. This sets the stage for a corporate tug-of-war with multinationals caught in the middle. In short, the world's supply chains are being redrawn, but the battle for who controls them has just begun. Beijing is countering the corporate exodus not with threats, but with targeted incentive packages, easing regulations, and quietly reopening the floodgates for foreign direct investment, FDI. In a sharp turn, China is now courting foreign firms with lower production costs and streamlined approvals, trying to reframe itself as a reliable partner amidst global uncertainty. Meanwhile, U.S. markets are flashing red again. The Dow Jones tumbled, and investors are asking, how long is this transition supposed to last? Trump's narrative? This is not a game, he says, casting tariffs as a patriotic sacrifice for future gain. But Wall Street isn't convinced. The losses are real and accelerating. The contradiction is stark. China is adapting, America is bleeding, and global capital is watching closely to decide where its future lies. We're protecting the country's interests, Trump insists, while trying to soothe Wall Street with talk of long-term gains. But markets don't trade on patience. They trade on earnings, expectations, and risk. As Apple, Amazon, and Microsoft see their share prices fluctuate wildly, millions of Americans are growing anxious. Why? Because their 401ks and pension funds are directly tied to these market giants. When these stocks fall, it's not just tech valuations that dip. It's the retirement security of the middle class that takes a hit. Trump urges Americans to ignore the short-term noise. But this noise is people's life savings evaporating in real time. This is no longer a theoretical trade war. It's a direct financial threat to U.S. households, and Wall Street knows it. Trump says, "Don't let fluctuations demoralize you." But economic experts warn, prolonged uncertainty doesn't just scare investors, it paralyzes markets. New projects are shelved, hiring slows, unemployment rises, and in this climate, Apple's pivot to India sends a chilling signal. While the U.S. claims to protect domestic producers, it's simultaneously fueling foreign investment flows. Global capital chases stability, and right now, Washington isn't offering, and meanwhile, Trump's long-standing accusation that China exploits open trade has now become formal White House doctrine. But what happens next? The answer is a minefield of scenarios. Apple leaving China, offloading U.S. Treasury bonds, China slapping restrictions on U.S. firms. As Apple shifts its production away from China, the ripple effect is immediate. Washington quietly supports the move, while Beijing prepares its next counterstrike. If the U.S. views this strategy as successful, a floodgate opens. Taiwan, Vietnam, and Indonesia are next in line, eager to grab a slice of China's lost tech dominance. What was once a question of, where else can tech manufacturing go, is now a global race. Who gets to replace China? But the stakes are high. This supply chain migration is messy, expensive, and economically dangerous. Tariffs are now